In the last few videos, we talked about what a mortgage payment is really made of, why guessing the payment keeps people stuck, and thirdly, why affordability is more flexible than people think. Now it's time to connect them all, somehow connect it, right? Because behind every approval or denial is one simple rule banks use. You don't need to memorize formulas. You don't need to be good at math, despite what you might think. You just need to understand this one idea. I'm going to make it as simple as possible so you can follow along with. Your house payment has to fit alongside your other monthly bills. That's it. Mind blown. That's why there's so many denials. Now, I'm break it down a little bit further, so stay with me. Banks don't just look at the house by itself. They ask, after you pay your car, your loans, your credit cards, and everything else, do you still have room for this house payment? That's not rhetorical, that's the question. That rule is what decides affordability. Most buyers think affordability works like this, right? I make X amount of dollars, so I should be able to afford up to Y amount of house, right? But that's not how the system works. Two people can make the same income and get very different answers. Why? Because income is only half the story. The other half is, what is your income already committed to? That's why some people feel confused. It's like, hey, I make good money. Why am I struggling to qualify? It's not your income. It's how much of it is already spoken for. In the mortgage world, the rule has a name, but you don't need to remember it. It's called debt to income ratio. Now, forget the term. Forget what I just told you. Forget it. Remember the meaning. How much of your monthly income is already going to bills? Banks usually want your total monthly bills, including the house, to stay under a certain portion of your income. Let's walk through it with another example, simplified. Let's say you make $10,000 per month before taxes. Banks generally want all of your bills combined, all of it, credit card, car note, or I don't know, what other bills you might have. All of it combined to stay under 45% of that. So what we're going to do is 45% of $10,000 is $4,500. That means your total monthly bills should stay under $4,500. Now, let's look at your other bills. Your car payment might be $600. Your credit card, maybe another $150. Maybe you have student loan payments that are another $250. That's $1,000 per month. So what's left for the house? $4,500 minus the $1,000 in bills and other expenses equals $3,500. $3,500 is now your target house payment. That's the rule. This is where things start to really click. You might be looking at a $500,000 house, while someone else might be looking at a $450,000 house. But the bank doesn't care about the price first. No, what they care about is, does this payment fit inside of your rule? That's why a cheaper house can still be unaffordable. A more expensive house can sometimes actually work. It all comes back to the monthly payment fitting the rule. Here's the part most people don't know. That rule is not fixed. You don't need a raise to change it. Small things can actually make a big difference. For example, paying off a small debt, lowering a monthly bill, or how about adjusting the price slightly, or changing how much you put down. Any one of these can increase how much room you have for a house payment. That's why some people qualify after making one small move. It's not magic, it's just math. Now you know the rule. This rule isn't there to punish you. It's there to actually protect you. Just because someone could stretch into a payment doesn't mean they actually should. Can you imagine you stretch yourself so thin that you can't afford anything? That's going to be kind of scary. So a house payment should fit your life, your groceries, your gas, your kids, your emergencies. The rule is simple. It is meant to stop people from becoming house poor. Smart buyers don't try to break the rule. They try to understand it, work within it, and make it work for them. See, rates do affect the payment, completely true. But remember, you live in the payment, not the rate. If you buy a house where the payment fits this rule and you can handle it today, if rates approve later, you may be able to refinance and lower it. But if you wait only for a better rate, guess what happens to prices? Prices start to rise. You're now locked into a higher price on a house forever. So don't chase the rate, chase a payment. But better yet, a payment that fits the rule. If you've been telling yourself, I can't afford to buy anything, I just can't, what's most likely happening is you didn't know the rule I just taught you. You didn't know how close you actually were, and nobody ever explained that to you. Once you understand this rule, buying a home stops feeling like a mystery. It becomes something you can plan for, something you can help other people do also. If this video helped you, if it made things finally make sense, that's perfect. The next step is learning how people can increase what they can afford without making more money. That's exactly what I break down in the next video. No pressure, just clarity. You don't need perfect credit. You don't need perfect timing. You just need to understand the rule. And once you do, everything feels more manageable.